Hello and good morning friends, welcome to the CEC-UGC live lecture. Dear friends, as you know that we are carrying a series on financial accounting, and so far we have conducted 13 sessions, 13 lectures on the very series financial accounting, and we have tried to understand about the various aspects under the series. Dear friends, today in this session we would be discussing on profit and loss account and closing entries, as well as we would be discussing preparing balance sheet, vertical income statement and balance sheet. And for this discussion we have once again with us within our studios Mr. MC Sharma. Mr. MC Sharma is Associate Professor in the Department of Commerce, Shahid Bhagat Singh Evening College, University of Delhi. His immense experience would definitely help us out in knowing the topic as well as the entire series. So I would like to welcome our guest Mr. MC Sharma. Mr. Sharma, welcome to the EduSet lecture.
Okay, thank you. Dear friends, in our last lecture we started final accounts, or that is the final step in accounting process, preparing financial statements. In the last lecture we discussed how to prepare a trading account. Trading account is prepared to calculate gross profit, that is excess of sales over cost of goods sold. We also learned preparing manufacturing account. Manufacturing account is applicable for manufacturing enterprises. They have to calculate cost of production, and for that purpose they prepare manufacturing account, and then they prepare trading account. In today's lecture we shall discuss how to prepare profit and loss account, how to pass closing entries, and how to prepare balance sheet. And we will also discuss some recent trends, that is presenting income statement and balance sheet in vertical manner. So we are starting first from profit and loss account. Profit and loss account is one of the important part of financial statements, or sometimes we say it is the most important part of profit and loss financial statement. Profit and loss account we prepare after preparing trading account, and the gross profit shown by trading account or gross loss is transferred to profit and loss account. In this profit account we record all the indirect expenses on the debit side. These expenses may include office and administrative expenses, selling and distribution expenses, financial expenses, depreciation and maintenance charges, and other expenses. In this account we record income other than sales, or we also call it non-operating incomes. And the balancing figure of this account is called net profit or net loss. If the credit side balance total exceeds the debit side, then balancing figure is net profit. If debit side total exceeds then credit side, then the balancing figure is net loss, which is transferred to the capital account in case of proprietorship firms and partnership firms. Now the question arises, what is the need and importance of preparing profit and loss account? As we know that the basic objective of the business is to earn profit, and every businessman, every entrepreneur is interested to know how much profit he has earned or he has incurred a loss. So to find out the net profit or net loss, we need to prepare profit and loss account. And with the help of this profit and loss account, we could also see the details of indirect expenses, because all indirect expenses are shown on the debit side of profit and loss account. This account also helps in preparing balance sheet. We will see when we prepare the balance sheet, we have to show owner's funds, which includes capital as well as the profits. So, whatever the net profit we earn, the business earns, is transferred to capital account to find out capital at the end of the year. So, for preparing a balance sheet, it is important to prepare the profit and loss account and find net profit or net loss. In a business, some provisions and reserves are required to meet the unforeseen circumstances, some uncertainties, and how much provisions should be made, how much reserve should be created. Provisions depends upon the item or for the purpose for which provisions are being made, but when we want to create the reserve, the amount of reserve depends upon the net profit earned. So, after finding the net profit, the firm may decide how much profit should be transferred to the reserve and how much profit should be distributed or given to the owner. And with the help of profit and loss account, we could prepare many important financial ratios. Ratio analysis is one of the important technique of analysis of financial statement, and profit and loss account helps in providing important information. Like if we want to calculate net profit ratio, or we need to find the net profit. If we want to calculate return on investment, then this account will provide the information on the return, that is profit before interest and tax. So, different types of the profits are disclosed by profit and loss account, and if we want to know if our profits are not sufficient or we are finding profits are less, then we could analyze the different expenses. Then in terms of the sale, the office expenses or selling expenses are comparatively less or more, and we could analyze them to control, how to control. So, this profit and loss statement also helps in calculating the different type of the financial ratios. Now, we will see the format of profit and loss account. In profit and loss account format, first of all we need to record the name of the firm, then profit and loss account, and then this account is prepared for a particular period. Here we have taken the example for the year. So, we have mentioned here for the year ending. If we are preparing it for 6 months, so we could write for the 6 months ending on this date. As this is a account and account format has the debit and credit side, so we have mentioned debit on the left side and credit on the right side. Then we do not require any date column because we prepare this at the end of the year. So, date column is not required. We start profit and loss account with gross profit. So, on the credit side you find gross profit brought down. So, first we have to prepare trading account and then we have to prepare profit and loss account. So, the gross profit disclosed by trading account shall be brought here. If there is a gross loss, then it will be shown on the debit side. On the debit side, we are showing office and administrative expenses, selling and distribution expenses, financial expenses, depreciation and maintenance, miscellaneous expenses and losses. On the credit side, we are showing non-operating recurring incomes, other incomes, net loss. So, after recording gross profit or gross loss and indirect expenses and indirect incomes, we have to find out the balancing figure. If this balancing figure is on the right side, that is on the credit side, then it is the net loss, and if balancing figure is on the debit side, then it is the net profit. We know that there is a variety of expenses in the different categories. So, sometimes there is a confusion to the new learners that whether this expense belong to office and administrative expense category or selling and distribution expense category or financial expenses. So, we would like to discuss the different expenses which may be covered under these categories. First, on the items which are shown on the debit side of profit and loss account, gross loss which is disclosed by trading account. Then second is office and administrative expenses. There are many types of office and administrative expenses which may be named in different manner. Here we have given some examples. Salaries. In financial accounting, it is considered that if we are using the term salary, it means it is for office staff. So, the salaries or office salaries, again it is that part of office and administrative expenses. Sometimes in questions there may be salaries and wages. When it is a combined, then some confusion arises, but there should be no confusion. If the salaries are given first, then we treat as salaries and show in profit and loss account, and if it is given as wages and salaries, then we assume that the component of wages is much higher and then that we show in trading account or in manufacturing account. Then indirect wages. Indirect wages are those wages which are paid to the staff other than those who are involved in production. Those who are involved in production activity actively, their wages is called direct wages, and other staff like storekeeper, security guard, accountant. So, the wages paid to these people is the part of indirect wages. So, if the term indirect wages is given, we will show in profit and loss account. Then printing and stationery. Stationery is required in the office and their printing charges. Then insurance premium. Insurance premium may relate to office building, office equipments, plant, machinery. But when we are preparing manufacturing account separately, then insurance premium of factory building and plant and machinery is shown in manufacturing account. And if it is a trading concern, then there is no factory or no production activity, plant and machinery. So, the insurance premium will relate to the office building and other equipments or items. Then the insurance premium will be shown in profit and loss account under office and administrative expenses. General expenses. General expenses may relate to the general administrative activities. Then audit fees. Audit fees is the fee paid to the chartered accountant for auditing the accounts of the firm. We know that in many cases the income tax department asks the firms to prepare the accounts and get them audited by a chartered accountant. So, the audit fee paid to the chartered accountant or auditor will be the part of office and administrative expenses. Then repairs and maintenance of building, plant, machinery, furniture. Then telephone and mobile expenses. You know, communication is very important activity in the offices. So, the telephone charges and mobile expenses. Nowadays, there may be the broadband charges, internet charges also. And rent, rates and taxes. Rent is paid for the office building, rates is a local tax, and taxes also like the property tax which is levied on the building. So, rent, rates and taxes may be a combined heading. Then postage and courier. Postage and telegram term was used previously, but nowadays the telegrams are not used and no telegram facility is available. Some time back the last telegram was sent and now this facility is not available. So, nowadays there will be the postage charges, speed post charges, courier charges. Establishment expenses are related to the office staff, then lighting or office lighting, that lighting expenses relating to the office, because the factory lighting is the part of the trading account. Then newspaper and magazines. So, there may be some other expenses which may relate to office and administration. Then selling and distribution expenses. In business, this is the very important activity. Every business has to adopt this selling and distribution. So, the trading expenses. This term sometimes confuses the new learners. The trading expenses should be shown in trading account, but trading expenses are basically related with the sale. So, they are shown in profit and loss account. Advertisement expenses, packing expenses, then rent of showroom or godown, entertainment expenses. This entertainment expenses in business, basically the expense which is required to entertain the customers. So, this is the part of selling and distribution expenses. Sales promotion expenses, there may be some free gift, there may be some distribution of samples, there may be any other scheme to promote the sales. So, the sales promotion expenses are also the part of this selling and distribution expenses. Freight outwards or freight on sales. Freight outwards is the freight which is paid on sale of goods when goods is sold. So, sometimes customer is not ready to pay the freight and firm has to bear it. So, it is considered as a part of selling expenses. Similarly, carriage outward or carriage on sales, carrying the goods sold from the godown to the customer's place. So, the carriage outward. Traveling expenses. Normally, salespersons are expected to travel from one place to another place to contact the existing and potential customers. So, it is also considered the part of selling and distribution expense. Then commission. Commission is usually paid to the agents for selling our goods. So, the commission debit, because why we have the debit? Debit is expenses. If commission is credit, then it will be the income and will be shown on the credit side of profit and loss account. Export duty, if the goods is exported by the firm, it is a sale, and any export duty borne by the firm shall be the part of selling expenses. And then free samples, the goods distributed the free to the existing or potential customers. Then bad debts or provision for bad debts. We know that when we start selling goods on credit basis, so there is a chances of the bad debts. So, the bad debts expenses are considered relating to the sales. As soon as the sales increases, the chances of the bad debts may also increase. Salesmen's salaries and any other remuneration, travelers commission, if the salesmen are paid some commission, delivery charges, there may be a delivery van with the firm, and showroom expenses, showroom charges, though there may be many variety, and just you need to apply the common sense whether this expense is related with the selling and distribution, then it will be the part of this category, indirect expenses. Financial expenses. Financial expenses are incurred to arrange the funds. It may be the short term funds or long term funds. So, interest on loan, interest on bank overdraft, interest on cash credit or working capital loan is the financial expense. Interest on capital, normally in case of proprietorship firm and partnership firm, interest may be allowed to the owners. So, again it is the financial expense. Then bank interest or interest on overdraft, then bank charges. You know that when you maintain the current account with the bank, nowadays many types of charges are levied by the bank. If you are unable to maintain the minimum balance, bank will charge some expenses from you. There may be if you are getting issued the checkbook more than the prescribed number, then again the bank will charge for the check leaves. So, sometimes bank also charges for the bank statement issued by them. So, there may be the different types of bank charges. Then discount debit or discount allowed. We have already studied that the discount may be two types, trade discount and cash discount. Trade discount is related to promote the sales or the trade. So, it is not recorded in the books, but when the cash discount is allowed, cash discount is allow to our customers or debtors for prompt payment or for making payment before due date. So, the discount allow is considered the financial expense. So, the financial expenses category expense, then depreciation and maintenance. We know that a firm requires fixed assets which may be tangible and intangible, and a depreciation is charged on fixed assets for its wear and tear and passage of time and some accident, etc. So, the depreciation charge on fixed assets, that is tangible or intangible, will be shown in this category, debit side of profit and loss account. Fixed assets may be building, plant and machinery, furniture, fixtures, motor vehicle, patents, trademarks. The depreciation charge on intangible asset is also known as amortization of intangible assets or goodwill. Repairs and maintenance, it may be like whitewash charges of building, repairing of furniture, repairing of machinery, equipment. So, in this category we shall record depreciation and maintenance charges. Miscellaneous, those expenses which may not be categorized under above mentioned categories. Number 1, office and administrative, selling and distribution, financial and depreciation and maintenance. Then these expenses may be recorded separately as miscellaneous expenses or losses. Some of the example of are the charity or donation, legal expenses, loss on sale of fixed assets, loss by theft, fire, accident, etc. So, all these are the expenses which may not be categorized under any mentioned above categories of expenses. Then items which are to be shown on the credit side. The first item is gross profit, which is disclosed by trading account, and other income. Other income may be classified into two categories: non-operating recurring incomes. Recurring means they are regular, like interest received on investment, rent received, then discount credit or discount received, then commission credit or commission received, then dividend received, then sundry receipts, any other. Non-operating or non-recurring incomes, the one example is bad debts recovered. Okay, the few years back a firm has written off some amount as bad debts, and in the current year it has been recovered. So, it will be non-operating and non-recurring income. Then profit on sale of fixed assets, a firm has sold the asset like the building, its book value was suppose 3 lakh and it has been sold for 4 lakh. So, there is a profit of rupees 1 lakh on sale of building. So, that will be shown as non-operating and non-recurring income on the credit side of profit and loss account. So, after preparing or recording these items, we find the balancing figure, which is known as net profit or net loss. Now we are showing a small example. Prepare the profit and loss account of Messrs. Joravar Singh Bawlal for the year ending March 31st, 2015 from the following balances given. We are given salaries, general expenses, rent, rates and taxes, carriage outward, interest received, advertising, discount, printing and stationery, gross profit. So, it means the trading account has already been prepared. So, we will start profit and loss account with the gross profit, and all indirect expenses shall be recorded on debit side, and all indirect income. Here is only the one indirect income, that is the interest received. So, you see this will be the presentation of profit and loss account. On the credit side, by gross profit brought down and then by interest received, then all expenses mentioned here in question shall be recorded on the debit side, because all are indirect expenses: salaries, general expenses, rent, rates and taxes, advertising, discount, and carries outward printing stationery, and the balancing figure is net profit, that is 14,910. So, we know that when we prepare the account, it is based on some journal entry. Although in the topic of journal entry, we have already mentioned about the closing entries. Closing entries are the journal entries which are passed at the end of the year to close the nominal accounts. All the nominal accounts having debit balances are closed by transferring their balances to the debit side of trading account or profit and loss account, as the case may be. All the nominal accounts having credit balance are closed by transferring their balance to the credit side of trading account or profit and loss account. We see here how many journal entries commonly are required. First entry for closing those accounts which are to be shown on the debit side of trading account. So, trading account is to be debited, trading account debit to opening stock, to purchases, to sales return, to wages, to freight. We have given some examples here, and entry will depend upon that what items are given in the question. So, this is the transfer of debit balances to the trading account. Here sales return has been mentioned. The sales return account has a debit balance, and when we prepare the trading account, the sales return is shown by deducting from the sales. But when we are passing entry, it will be part of this entry, because all these accounts have the debit balances. Then second entry for credit side items of trading account, that is the sales account debit, purchase returns debit to trading account. Purchase return account has a credit balance, and so it will be closed by transferring its balance to trading account. But in final account, we know that the purchase return is shown on the debit side by deducting from purchases. One more item we show, that is the closing stock. Closing stock entry is the part of adjustment entry, and we pass for that closing stock account debit to trading account. So, now we will find the balancing figure by preparing the trading account, that will be gross profit or gross loss. For gross profit, trading account debit to profit and loss account, and if there is a gross loss, then profit and loss account debit to trading account. The next entry we pass for the debit side items of profit and loss account, that is indirect expenses. Profit and loss account debit to indirect expenses. Entry will be all individually, all expenses shall be mentioned. Then for incomes which are to be shown on credit side, so other income and gains account debit individually to profit and loss account. And the balancing figure of this account will be net profit or net loss. And we know that the net profit or net loss is the part is transferred to capital account. So, these are the closing entries based on the basic principles of debit and credit, and so whatever the balances are given, the closing entries may be passed to prepare the trading account and profit and loss account. So, in this session we discussed how to prepare a profit and loss account and how to pass closing entries. Welcome back to the second session. In this session, we shall discuss the balance sheet. Balance sheet is also known as a position statement. Balance sheet or position statement is prepared at the end of the year as on the last day of financial year or accounting year. And in this statement, we shows the assets owned by the business and the liabilities owed on a certain date, that is at the end of the year. So, balance sheet is very important statement, and this shows about the financial position of the firm, okay, how much assets it owes and how they have been financed. As far as the important aspect or characteristics of balance sheet is concerned, it is prepared after preparing trading account and profit and loss account, because before preparing a balance sheet we need to find out the net profit or net loss which is disclosed by profit and loss account, and it is prepared on a particular day. So, usually we prepare the balance sheet on the closing day or the last day of the accounting period. So, it is not prepared for a particular period, it is prepared as on, because the financial position we show as on particular date, normally at the closing hours of the business. It shows financial position of a business as a going concern. Going concern is one of the important accounting principle which we have discussed in our initial lectures. According to the going concern accounting principle, the firm's assets are valued on the basis that the firm will continue to do the business for indefinite period. So, the valuation of the firm's assets is not made on terminal value basis or the market value basis, they are valued on the basis of firm as a going concern. And it is a statement, not an account. So, we do not use the debit or credit side, we do not use the word to or buy in balance sheet. There are the two sides, one is the left side, that is capital and liabilities, and on the right side we show the assets. In case of the balance sheet of the companies, liability side is called equity and liabilities, and the asset side is the assets. There are various types of assets and liabilities which are presented in the different orders or preference, which we shall discuss later. This preference may be either liquidity preference or permanence preference. Another thing which we find, that the balance sheet is always tallied. If balance sheet is not tallied, it means that something is missing or there is some error or omission by the accountant. So, he will check the accounts and find out the error or omission and see, will ensure that the balance sheet is tallied. Before starting the format or preparing that balance sheet, we would like to know the classification of liabilities and assets. First, we are talking of classification of liabilities. On the liability side, there are mostly the three main headings which we find in case of non-corporate concerns as well as in case of corporate concerns. In case of non-corporate concerns, the one item is owners' funds. Owners' funds are the funds which have been contributed by the owners. So, capital is one of them. The capital is the amount invested by the owners or partners in the business, and the surplus, that is the profit, or any the reserve, that is the free reserves, they also belong to owners. So, the owners' funds include capital plus reserves and surplus. Then long-term liabilities or non-current liabilities. Non-current liabilities are those liabilities which are payable by the firm after 1 year. So, these may be the long-term loans, mortgage loans. In case of a company, they may be the debentures. So, any loan taken by the firm for more than 1 year, that will be classified in this category. Whether it is the secured and unsecured, it does not matter. Then third category is the current liabilities. Current liabilities are those obligations of the firm which are to be met in the near future, that is generally within 1 year. For example, there may be creditors for goods. It means that the firm has purchased the goods on credit basis, so there is a liability which we call creditors. Or there may be the bills payable also, and combinedly we call them trade payables. There may be bank overdrafts, bills payable, short term loans or cash credit. Cash credit is a facility provided by the bank to finance the working capital of the firm. What are the main advantage in cash credit? That the interest is payable only on the actual amount used. But there is one more category of liability, that is contingent liability. Although you won't find as a part of balance sheet, it is shown as a footnote, that is the separately outside the balance sheet. This is very important liability. What is contingent liability? There are some possible liabilities which are not actual liability on the date when we are preparing the balance sheet, but they may become a real liability after some time or on happening of certain event or contingency. So, these are called contingent liabilities. So, contingent liabilities are to be mentioned as a footnote according to the disclosure concept, because the information user, that is investor or bankers or lender, he would like to know the contingent liability of the firm also that may happen in future. Some examples of contingent liabilities are claims against the firm or company not acknowledged as debt. It means that there is a claim against the company by some authority, but the company has not acknowledged it. Sometimes there is a tax dispute. Income tax department or sales tax department, excise department may file a claim against the firm that this much amount is payable, while the firm do not agree with this. So, it is a disputed liability, or it is a claim against the company or firm which is not acknowledged as debt by the firm. Then uncalled liability on partly paid shares. If the firm has purchased some shares of a company and they are partly paid. Suppose a firm has purchased the shares of ABC Limited, 1 lakh shares of 10 each, and paid only 7 rupees per share. It means the rupees 3 per share may be called by the company at any time. So, that rupees 3 per share is the uncalled liability on partly paid shares. So, company has to disclose this, the liability on partly paid shares. Arrears of fixed cumulative dividend. This is in case of corporate concerns only. In corporates or companies, there are the two types of shares, equity shares and preference shares. In case of preference shares, the fixed amount is payable by the firm. Preference shares may be cumulative preference shares or non-cumulative preference shares. In case of cumulative preference shares, if the dividend is not paid by the company, then it continues to become as arrear. So, it is a contingent liability, because whenever the company will earn profit, it has to pay the arrears of preference dividend. So, that is the contingent liability. Then estimated amount of contracts remaining to be executed but not provided for. Suppose the firm has given a contract of rupees 20 lakh for construction of a building. Out of that, rupees 10 lakh has already been paid, the building is not complete. So, the rupees 10 lakh are to be paid in future when the building will be complete. So, this is the estimated amount of a liability or the contract which is to be executed and company has not made provision for this. Then liability under a guarantee. If the firm has given any guarantee for a loan for some other person, so if that person does not make the payment of its loan, then the firm has to pay. So, the liability under a guarantee are also to be disclosed as contingent liabilities. Then liability on bills receivable, discounted but not matured. There are certain bills which have been discounted by the firm from the bank. Their maturity date will come after 1 month. So, when we are preparing a balance sheet, we have to show it as a contingent liability. Reason being, if the bill is not paid by the drawee on due date, then the bank will ask the firm to make the payment. So, it is a contingent liability. There may be another money which is contingently liable, means it depends upon happening. In just for example, an employee have been terminated and he has filed a case for a compensation against the firm for rupees 1 lakh. The firm has not acknowledged it, the case is pending. If the case is decided in favor of the employee, then the firm has to make payment of rupees 1 lakh. So, it is a contingent liability. There may be any other item also which is a liability and depends upon happening some event. So, these are the certain examples of contingent liabilities. Now, we will discuss the classification of assets. There are different types of assets. Normally, the assets are classified into two categories: fixed assets and current assets. Fixed assets are also called non-current assets. These fixed assets are purchased for the purpose of operating the business and not for the purpose of resale. So, they are required in the business permanently or for the long term. So, we call them the fixed assets or non-current assets. Fixed assets or non-current assets further may be classified into two categories: tangible assets and intangible assets. Tangible assets are those assets which have physical existence. They may be touched, they may be seen. For example, land, building, plant and machinery, furniture, motor car, cattle or livestock, equipments. So, all these are the examples of tangible assets. There may be certain intangible assets also. Intangible assets are those assets which have no physical existence, but they can be sold and purchased. Important examples of intangible assets are goodwill, patent right, copyright, trademark. The other category of assets are current assets. Current assets are kept for the short term and are required for day-to-day business activity. For example, stock of raw material, stock of semi-finished goods, stock of finished goods, debtors, bills receivable, bank balance. These are the examples of current assets, because they are held by the firm not more than 1 year. Even some assets may be converted into cash within a month or within few months. Under the current assets, there is another category that is known as liquid assets. Liquid assets are those assets which can be easily converted into cash at a short notice. Cash in and bank balance, they are already in the cash form. Then debtors, BR, are also considered as the examples of liquid assets. Knowing the liquid assets will help in calculating some ratios. There is one ratio which we call that is liquid ratio. So, liquid ratio tells the firm's ability to make payment of current liabilities. So, in there we compare current assets with liquid assets. Then, so these are the liquid assets. Then fictitious asset. Fictitious assets are those assets which are shown in the balance sheet as asset, but having no market value, or in other words we cannot sell them in the market. It means that they are assets shown, but there is no real value. So, that is why we call them fictitious assets. Some of the examples are preliminary expenses or company formation expenses, accumulated losses. So, these are the fictitious assets. Now, we will talk of marshalling of balance sheet or marshalling of assets and liabilities. When we prepare a balance sheet, we show or we prepare the balance sheet in a particular order. So, recording the assets or showing the assets and liabilities in a particular order is called marshalling of balance sheet or marshalling of assets and liabilities. As we know, the assets may be the non-current and current, liabilities may be non-current and current. So, it depends upon again what format we want to show. There are two orders, one is liquidity order and another is permanence order. In case of liquidity order, so first we should know what is liquidity. Liquidity means the convertibility of assets into cash. How an asset can be converted into cash? If it can be easily converted, then it is considered the liquid assets. So, according to liquidity preference, the most liquid assets are shown first, and assets which are most difficult for conversion into cash are written last. In between, the same order is followed. Similarly, when liabilities are recorded in liquidity order, the first we record short term or current liabilities, then long term liabilities, and then the capital, because the capital is paid in the last. Outside liabilities are paid first. If we put the different assets and liabilities in the proper format of balance sheet in liquidity order, we will find this like this. So, this is the format of a balance sheet based on liquidity order. On asset side, we have shown current assets first, and even in current assets, we have shown cash in hand first, most liquid, cash at bank, can be withdrawn from bank any time, then debtors, bills receivable, stock in trade. Stock in trade and prepaid expenses are considered non-liquid, because the stock in trade cannot be sold immediately, because if could have been sold, then why we should keep in stock. And prepaid expenses, we get the services against the prepaid expenses, so they cannot be converted into cash. Then investments a detail is required, like investment in shares, investment in debentures, or in any other format. Then non-current assets we should show tangible assets and intangible assets. Tangible like land, building, plant, machinery, furniture, motor car, and intangible assets are goodwill, patents, trademark. If we see on the liability side, current liabilities are shown first. Creditors, bills payable, bank overdraft, outstanding expenses. income received in advance. Income received in advance is comparatively less liquid because we are not expected to pay it immediately. We will provide some services against this income. Non-current liabilities, loan, mortgage, then owner's funds, capital, then we add the net profit to this, and if there is a net loss it will be deducted, and if there the drawings are given they will also be deducted. So, this is the format of a balance sheet, but based on liquidity order. We need to know the another order, that is permanence order. Permanence order is basically those assets which are more permanent in the business, or we could say the required in the business for the long term are recorded first. So, we record the fixed assets first and the most liquid assets in the last. Similarly, on the liability side we show capital first because it is the most permanent, and then long term liabilities or non-current liabilities and current liabilities. So, this arrangement of assets and liabilities will be just reverse of that shown in the balance sheet prepared on liquidity preference. So, if we prepare a balance sheet in permanence order, we shall find out this format of a balance sheet based on permanence order. So, on the asset side first we are seeing fixed assets, goodwill, plant and machinery, building, land, furniture, fixtures, investments, give detail, then current assets, stock in trade, prepaid expenses, debtor, BR, cash at bank, cash in hand. On the liability side, capital, then we add the net profit to the capital, and if there is drawings are given, drawings is the amount which is withdrawn by the owner for his personal use, that is deducted, and the capital at the end of the year is shown in the amount column. Then long term liabilities, that may be loan, mortgage, then current liabilities, creditors, bills payable, outstanding expenses, income received in advance, bank overdraft. Normally, if you see any financial statement or any balance sheet, you will find this order is used. So, most of the time while preparing a balance sheet, the order of permanence is used. Now, we will see if the income statement and balance sheets are prepared in vertical manner. Nowadays, whenever you study or read annual report of any company, you will find the income statement and balance sheet in vertical manner. This presentation of income statement in vertical manner provides a better information and which helps in the financial analysis and preparing ratios. We see this format. First of all, gross sales. If there is any net sales return or the excise duty or sales tax collected, that will be deducted. So, finally, we shall record the net sales only. Then we have to deduct cost of goods sold. Cost of goods sold shall be calculated opening stock plus net purchases. Net purchases means purchases minus purchase return. Then direct expenses. Direct expenses are those expenses which have been incurred on purchase of goods or on manufacturing goods. So, and then we shall deduct the closing stock and we will find out the COGS or cost of goods sold, and cost of goods sold will be deducted from the net sales and the balancing figure will be gross profit or gross income, and if it is in minus, then this will be gross loss. After finding gross profit, we have to deduct operating expenses. Normally these three categories of expenses are considered as operating expenses: office and administrative expenses, selling and distribution expenses, and financial expenses. After deducting operating expenses from gross profit, the balancing figure we find is operating profit before depreciation. This operating profit before depreciation, then we deduct the depreciation. Depreciation is a non-cash expense, and we find the operating profit after depreciation. Then we add non-operating incomes. It may be rent received, it may be interest received, it may be discount received, it may be dividend received, it may be profit on sale of fixed assets, any item which we have already discussed. And after adding this non-operating incomes, we shall deduct non-operating expenses. Non-operating expenses may be loss on sale of fixed assets, legal charges, any penalty, fine. So, these may be deducted and we find the balancing figure: profit before interest. Profit before interest, then we deduct the interest and we find net profit. Here we have not deducted the income tax, because in case of sole proprietorship or individual business owners, the business income is not subject to income tax. This profit, when shown as in their income of the owner, only then the tax is charged. So, otherwise we could modify this, then after deducting interest we find profit before tax, and then we make a provision for tax, then deduct the tax and find the net profit after tax. Now, we will see the vertical format of the balance sheet. In vertical format of the balance sheet, we are showing here the fixed assets first, or non-current assets, land and building, plant, machinery, furniture, fitting, investments, other fixed assets, and working capital. Working capital is calculated as current asset minus current liabilities. So, we need to show here the current assets and deduct the current liabilities from them, and after adding working capital to fixed assets, we find the figure which is called capital employed or the long term funds employed, which is represented by, if we deduct the long term loans from capital employed, then we find out the net worth or proprietor's fund or owner's fund, which is represented in case of the individuals and partnership firm by capital plus net profits less drawings. So, this is the presentation difference, and which provides much more information and better understanding. So, all corporate concerns meant in the vertical format. So, dear friends, today we discussed preparing profit and loss account and preparing balance sheet and their vertical formats. So, thanks, and we expect your feedback and your queries, so which we may include in our coming lectures. Thank you.
With this note, thank you sir, thank you so very much, and yes, as Mr. MC Sharma himself said, keep updating us with your feedback at info.cc@nic.in. We would be meeting again very soon and would be discussing further under the series Financial Accounting. Till then, take care, goodbye. Thank you sir, thank you so very much.